Welcome back, everyone. We're diving into the world of investing today. Specifically, we're going to crack open a classic. It's Benjamin Graham's The Intelligent Investor.
A fantastic choice, really foundational stuff.
Yeah, I mean, this book's been guiding people for decades. But you know what's funny? Even super smart people, like Sir Isaac Newton, made some terrible investment decisions.
Oh, absolutely. Newton's a great example, right? It shows that investing well isn't about being a genius.
It's not.
It's much more about how you behave, your mindset. And Graham really hits on that in The Intelligent Investor. That's what he calls intelligent investing.
So less about secret formulas, more about like inner game.
Exactly. You don't need some crystal ball.
So what does Graham say makes for intelligent investing behavior?
Well, he talks a lot about patience, discipline, a commitment to learning, keeping your emotions in check, and thinking for yourself.
Those sound like pretty solid life skills too, not just for Wall Street.
That's the beauty of it, They're things anyone can work on, no matter what your background is.
So it's encouraging. Instead of trying to predict the future, we build good habits for decision making.
Right. And one big thing that tricks people up, it's how markets actually work. Graham has this great concept he calls Mr. Market.
Mr. Market. Okay, I'm curious.
Picture this, right? Every day, Mr. Market comes knocking on your door. He wants to buy or sell stocks from you.
Sounds friendly enough.
The catch is, Mr. Market is moody. Really moody. Some days he's euphoric, overpaying for everything. Other days, he's a total downer, practically giving stocks away.
Uh-oh. Not sure I want to be business with someone that volatile.
And that's the danger. If you let Mr. Market's emotions drive your decisions, you're going to buy high and sell low, the exact opposite of what you want.
So how do we not fall for that? How do we stay calm while Mr. Market's freaking out?
Graham's got a strategy. Especially for folks new to investing, it's about being defensive.
Defensive investing. Okay, what's that entail?
It's about minimizing risk, building a portfolio that can handle the market's inevitable mood swings.
Sounds like a smart move, especially when you're starting out. So how do you do that in practice? What does that actually look like?
Graham suggests a mix. Part of your money goes into high-grade bonds, like government bonds. They tend to be pretty stable.
Makes sense. So that's our safe bet. Then what?
The other part, you diversify it among stocks. But not just any stocks. You go for leading companies, ones with a proven track record.
Interesting. Why that combo? Why not just one or the other?
Well, the bonds, those give you stability, right? They're less likely to go haywire when things get bumpy. Stocks, they give you the potential for growth over time.
Ah, okay. So it's about balancing those two out.
Exactly. It's about riding out the ups and downs, Markets are going to fluctuate. It's inevitable. This mix helps you handle that.
So our portfolio is ready to handle Mr. Market's mood swings. But how do we actually pick the right stocks? I mean, there are thousands out there.
That's where things get fun, right? Graham talks about finding undervalued companies.
Undervalued, like hidden triggers.
Exactly. Sometimes they're right in front of us. Graham himself had a knack for this.
Oh, I bet. Any examples?
Yeah, back in the 1920s, there was this company, Northern Pipeline. It was trading for like $65 a share.
Okay, pretty standard, right?
But get this. The company held more than $80 per share in high-quality bonds.
Wait, so it was worth more just in its assets than what the stock was going for?
Exactly. The market completely missed it.
What did Graham do?
Well, he saw the opportunity, bought shares of Northern Pipeline, then used his position to push for a higher dividend.
Smart move.
3 years later, he sold those shares for $110 each. Not bad, huh?
Wow, that's a heck of a return. But how do we find those undervalued companies today? Do we need to become like financial wizards?
Not necessarily. Graham lays out a few ways to approach it. One thing he suggests is looking for companies whose stock is trading below their net working capital value.
Net working capital. Can we break that down a bit?
Sure. Imagine you could liquidate a company today, sell off everything, pay off all the debts, what's left over. That's essentially your net working capital.
Gotcha.
If the company's stock is trading for less than that leftover amount, it's like getting their assets for free, buildings, equipment, the whole shebang.
So we're looking for companies on sale, basically.
You got it. Of course, it's important to do your homework.
Yeah, there's got to be a reason their stock is so low, right?
Sometimes, yeah, maybe something's wrong. But other times it's just the market overreacting, maybe to some short-term news, or they haven't caught on to the company's real potential yet. That's where those opportunities pop up.
So patience, a little bit of digging can pay off big time. Now, I know Graham wasn't a fan of trying to time the market, buying low and selling high based on predictions.
Right.
But he did say market fluctuations can create opportunities. How do we take advantage of those without becoming day traders, constantly glued to the ticker?
He had this idea called formula investing. It's a way to be systematic about it.
Formula investing. Sounds intriguing.
It's about setting a target for your portfolio. Like, let's say you want 50% stocks, 50% bonds.
Okay, balance.
Right. So if the stock market booms and your stocks suddenly make up 60% of your portfolio, you sell some and buy more bonds to rebalance.
I see. And if stocks tank?
You do the opposite. Buy more stocks, sell some bonds. It keeps you aligned with your target.
So you're kind of buying low and selling high automatically.
Pretty much. It takes the emotion out of it, which is huge. And it goes back to Mr. Market, right? You're actually using his mood swings to your advantage.
Clever. Now, what about investment funds? I know Graham had some thoughts on those, especially mutual funds.
Yeah, back then, mutual funds were pretty new. And Graham, he was a bit skeptical.
Skeptical how?
He pointed out that a lot of these funds charged high fees, but often didn't even do better than the market itself.
So you're paying someone to potentially lose your money. No thanks.
Exactly. He thought most folks would be better off building their own portfolio, spreading out their investments, or just putting their money in a broad market index fund.
And that's advice we still hear today, right? Index funds are super popular. But let's be real. Not everyone wants to spend hours researching stocks. So what do? Just hand our money over to a fund manager and hope for the best?
Not quite. Graham had some guidance for that too. His main point was to look at the fund's long-term track record.
Not just how it's done in the past month or two.
Right. Ideally, you want to see how it's performed through good times and bad times, years, not weeks.
So don't be fooled by flashy short-term returns. Got it. What else should we watch out for?
Graham was really cautious about funds with high turnover rates. That means they're constantly buying and selling stocks.
Which probably means lots of fees, right?
Exactly. All those transaction costs can eat into your profits.
So what's a good turnover rate to look for?
There's no magic number, but Graham preferred funds with lower turnover. Meant they were more patient, taking a longer-term view. And in general, he said, keep it simple.
Simple good.
If you don't understand a fund's strategy, if you can't explain it in a few sentences, it's probably best to steer clear.
Great advice. If it sounds too good to be true or too complicated, it probably is. This has been fascinating, really getting into Graham's world. But there's one big question we haven't tackled yet. Should we even be picking individual stocks? What did Graham say about that, especially for those of us who aren't, financial professionals? So, bottom line, did Graham think picking stocks was a good idea, especially for regular folks who aren't finance experts?
Honestly, he thought most people would be better off not picking individual stocks at all.
He was team index fund then.
Big time. He said for most investors, a low-cost index fund is the simplest, most effective way to grow your money over time. Captures the overall market growth without all the hassle.
Makes sense. That advice is still super relevant today.
Absolutely. Even Warren Buffett, on the GOAT of stock picking, he recommends index funds for most people too.
But what about those of us who like the idea of researching companies? Maybe finding those hidden gems. Did Graham think there was any place for stock picking?
He didn't rule it out completely, but he had a high bar. He said if you're going to pick stocks, treat it seriously, put in the time, do the research. This isn't a game.
So no picking stocks based on gut feelings or what you read on Reddit?
Nope. Graham had specific criteria, even for what he called the enterprising investor, the ones who wanted to be more hands-on.
Okay, lay it on us. What were Graham's stock picking secrets?
Well, first off, look for companies with a strong track record. Consistent earnings, a good price-to-earnings ratio.
So solid fundamentals. Makes sense.
He also liked companies that paid dividends. To him, it signaled they were financially healthy and that management cared about their shareholders.
Right, they're sharing the profits. But how do we avoid getting caught up in all the market hype or freaking out when things go south?
That's where Graham's focus on emotional discipline comes in. Remember, Mr. Market, you can't let his mood swings mess with your head. Stick to your research, focus on those fundamentals, and stay away from risky bets.
Slow and steady, like a tortoise winning the race. This deep dive has been eye-opening, really. Any final thoughts for our listeners, especially the newbies?
Sure, just a few key things to remember. First, investing is more about behavior than brilliance. Be patient, disciplined, and keep learning. Second, don't try to time the market. Think about a systematic approach, like dollar-cost averaging or rebalancing. Third, diversify, spread your bets. A low-cost index fund is a great place to start. And lastly, if you do decide to pick individual stocks, be serious about it. Do the research, focus on the fundamentals, avoid those speculative traps.
And never forget Mr. Market. He might try to tempt you, but you're in control. Well, that wraps up our deep dive on intelligent investing with Benjamin Graham. Hope you enjoyed it. Remember, the more you know, the better equipped you are to handle your finances. Thanks for joining us.